Vertical events acknowledge the traditional owners of the land on which we meet today, the Yagal people of the Eora Nation, and pay our respects to elders past and present.
Good morning. Welcome to beautiful Sydney. It's great to be here for the TechKnow Invest Roadshow 2024. As many of you would know, this is the first leg today. We're in Sydney. So you lucky investors get first crack at all these great companies that are presenting. And then tomorrow, we're off to Melbourne to do it all again. But it is great to be back in Sydney. As some of you have reminded me today, we kind of skipped the Sydney leg last year and did a Gold Coast Melbourne, and then we realised that we have such strong investment appetite in this city, so it's great to be back here showcasing some outstanding and progressive tech, biotech, diversified companies today. So we're really looking forward to a busy day. Our registrations are extremely strong, so it's great to see that the investment appetite is back in this sector, and no doubt that as the day progresses, we're only early, almost 9 a.m. in the morning, we'll see a huge number of people here and all enjoying the great companies that are presenting. But a conference like this wouldn't exist without our sponsors, so we're very lucky and fortunate to have the Lynn partners. Thanks to those guys, they are great supporters. I'm sure their slide and logos will pop up on the screen any second now. Oh, there they are. Great to have links. As well, Joe Durack and his team are on board. Joe's helped out with signing up a number of his clients that are participating today, and really appreciate to Joe. He's also helped with getting Naveed, who's going to be our keynote presenter. He'll be on the stage very shortly. So thanks to Links. We'd also like to acknowledge Steinerpag. Toby Hicks is in the room, so thanks to Toby. He's also associated with DigitalX. So their presentation will be coming up between morning tea and lunch, so it's a great presentation to see. Got our media partners, Chapter One and Investing News Network. Thanks to those guys. Dave Tasker will be wandering around from Chapter One. He'll be doing some interviews over there in the corner, so make sure you reach out and have a chat to him. Then there's Market Tech. Great to have Chris Hill. He'll be based at the Spender table. Market Tech, as some of you would have seen in an email that went out a couple of days ago, have got a bit of an incentive that if you sign up to their platform, it's all free and all that stuff, you go into the draw to win a prize today. So definitely worth looking into that. We're just going to play a short video for Market Tech now, just to give you a bit more of an understanding. Yeah, thanks. Obviously, there was a lot of information in that video, so I'd strongly suggest you track down Chris, have a chat to him. He's at the back with his arms waving at the moment. But, you know, I'm sure you all trade on different types of platforms. And the advantage of their platform is it has a lot more information. And we're actually live streaming all the presentations on each of the ASX listed companies' platform on Market Tech, as well as we're also live streaming this across a number of different platforms, YouTube and LinkedIn. So looking forward to a great day. Welcome Chrissy Morrissey, our MC, to the stage, and have fun.
Thanks, Jaxon. Hello, team. It's lovely to see you all here this morning. We've obviously a number of our team has flown across from Perth yesterday, so we're a little bit bleary-eyed because we were already dealing with the time zone difference, and then a number of us this morning got up and watched a certain swimming final at the Olympics. Anyone else get up early to watch that? Yeah, that was very exciting, wasn't it? Lots of things happening with the Olympics. And I've been around and had a chat with the majority of our presenters this morning. For those of you who I haven't seen or spoken to yet, expect a little chat with me during the day. I want to get the real highlights out of your presentation so that we all know what it is that we're chasing when we're sitting here in the room and listening to these potential investment wins that we're going to put in front of you over the course of the day. And a couple of those that I've spoken to already have said, I said, have you seen the Olympics yet? And they've said, Chris, you've been too busy, you know, getting ready for this presentation today and getting things ready for the team that are coming in. So I'd like to hear your experiences over the last couple of days, what you've seen on the Olympics, what were your winners, and then I'd like to hear from you about what you thought about our presenters today as well. I know there's a couple of you that have come along here today, and it's nice to see some of our regular faces at Vertical Events Do's who haven't been to our TechKnow conference before. So with that in mind, and we were having a chat outside about what it was that you could expect from this conference, we've got a very special first presenter up here on stage. I want to introduce you all to Naveed Hussain. He's from Novus Capital. He is a senior corporate advisor from them. And what we're going to have a look at is where are we in the economic cycle in terms of the technology sector, and how do you analyse technology shares? How do you find a winner in amongst all of these amazing companies? Because I think one of the interesting things with technology, and often you'll find a medical technology or something, you think, wow, that's amazing, how do they do that? But is it going to translate to a win in your investment portfolio? So Naveed, if you would like to come up and join us, sir. Look at him walking slowly. Will you just jump up? You just jump up here on stage next to me? All right. We've got an interesting stage up here today. It's rather slender. So for those if you put your hands together, please, and welcome Naveed. I'll jump off the stage and we'll talk in depth as the day goes on.
Thank you. Thank you, Vertical Events, for organizing this conference. And thank you, Joe, for putting me on the spotlight. And above all, thank you all the participants and investors coming to this conference. I hope you find this presentation at least some productive and interesting. I started my career in academia, and I was after completing my master's, I started teaching, and I was teaching accounting and finance. So I knew the balance sheet, profit and loss statements, net present value, and stuff. But then I joined the investment bank, and when I joined the investment bank, I realized I didn't know much about the investments because most of them were economists. They talk about the economy. And we had 3 economists in the bank. One was the global economist. The second was the national economist. And the third was the in-house economist. And those 3 never agree among each other. One was a bearish, one was bullish, and the third one was in between. All the 3 like was to drink. So they like drinking. So when they start drinking, and I used to join them, and I thought I'll take some wisdom from them. But I screwed up. So the part I didn't screw up, I've put in the presentation. So hope one of the things in economy is that there are so many variables, so there's nothing certain. It's subjective. Everyone has their own views. I try to summarize it in a more, try to do that. And my interest is that basically coming from the academia, go to the source. Just find out what's the reason behind it. So you might have your own opinions, but this is just a summary of where we are today in the economic cycle and how technology sector fit in that economic cycle. So this is the disclaimer I was asked to put by Novus Capital. And there's no advice, it's just a general presentation. Okay, I'll start with Benjamin Graham quote. Benjamin Graham was the father of investing, and he was the teacher of Warren Buffett. And he said the successful purchase of growth stocks require two rather obvious conditions. First, that the prospect of growth be realized. And second, that the market has not already pretty well discounted these growth prospects. Basically, the stock market is anticipating the anticipation. So a stock market usually anticipates most of the information. So if you want to make money, you have to anticipate the anticipation. So the reason you are in this conference is to find out that there is a growth prospect and it's not realized by the market. And the best way to know that is to go to the stalls, listen to the management, get some nuances there, and that will and basically the second the market has not already pretty well discounted in the price. So those are the two most important things in the market. One is to anticipate, which the market has not anticipated, and it has not discounted that price. So basically the economy, the traditional economy, the bottom line is that there are two things in the traditional economy. One is inflation and that interest rates. And why is interest rate goes up? Because of high inflation or inflation is rising. And why is inflation rise? Because there is economic growth. You can transfer, the prices are increasing. The companies can transfer the higher prices to the consumer. So you have a strong economic growth. That's usually the reason for the interest rate increase. Usually people think if interest rates are increasing, the share price will come down, but usually the share price goes up. And if there is a growth, the price earning multiple expands as well. And once the price, and then that's the start of a bull market. So basically the first 3 or 4 interest rates, the market usually rise. And then if the market start rising quite high, then what happens is that then the Reserve Bank, and the inflation goes out of the band range, then the Reserve Bank try to increase the interest rate higher and try to control the economy. So basically, what happens is that after 4th or 5th interest rate, market realize that Reserve Bank is going to put the interest rates higher and higher. So market anticipate that and say the economy is going to come down. So after 4 or 5 interest rate, then the market start discounting the decline after that. So that's what happens, that economy is doing well. Interest rates are going up, but the markets start coming down. So basically market anticipate what's happening in the future. And the second part is basically, then when the interest rates start coming down, why the government start reducing the interest rate or cutting the interest rate? Because they anticipate the economy is coming down, it's declining, and there's the chances of recession or deflation. And that leads to shrinking P multiples. So when the interest rates start coming down, you'll realize that the high growth stocks, the P multiples are high, they start coming down as well. And that's the start of the typical bear market. But the market already factored that before, when the interest rates were going higher after 4 or 5 times, or after 4 or 5 rate increase. So this is the traditional economic, this is how it used to work. But then what we have is that then the COVID happens. And when the COVID happens, then financial repression, because the government start reducing the interest rates quite significantly, and also stimulating the economy by fiscal policies. And also there's a disrupted between demand and supply. So when there is so that leads to, because of the overstimulus and low interest rates, there is the money went into the markets. So that's the start of a bull market because of zero interest rates and stimulus. And that leads to a higher inflation. And then the Reserve Bank start preparing the market for interest rate increase. And when the market, because of the change, because of such a, economy works when everything works in a normal fashion. But when this extreme thing happens, like zero interest rates and stimulus, then the market get disruptive. And that's where the market, when the interest rates start going up, the market realized that because the prices were high and market did not, so there was a pessimism in the market. Last year, there was so much pessimism in the market in the conference early in the year. And because everyone was expecting interest rates are going up and interest rates, and that's what's happening, high interest rates. So then what happens? Suddenly, similar to 1995, we have AI. AI came into the picture. And that pretty much changed the landscape. And now the AI, what will happen is the AI, the integration of AI across industries will revolutionize businesses, operation, customer experience, and data analysis. So next few years, you will see most of the companies announcing AI to the business. They have, because of AI, they have able to expand the revenue or cut the cost, become more efficient. Some companies will become disruptive companies. So that's gonna, and one of the things, like when AI happens, there is always one company that becomes very, very popular. Just like when the internet boom happened, Cisco became the top company. When the platform came in, Facebook and became a bigger company. And so this time, Naveed became one of the most valuable company in the world. It touched market capitalization of nearly $2 trillion. And so even in the high interest rates environment in America, the market was going up because of AI. Now, and also because of AI, the companies were able to reduce the cost and stuff. So there is the inflation has subsided. So they expect in America to cut interest rate in September. So the market is very buoyant. So the money is coming back in the market. That's what's happening. So, so what's the potential benefits for lower interest rates if the interest rates in America comes off? It will definitely benefit the tech sectors because one is there is a growth in tech sector and then the interest rates will be lower. So it's a double benefit for the tech sector. So that's the most important thing. And especially the small caps, because Naveed is like the top companies, so it will trickle down to small companies as well, and ultimately to small caps. Now, how do you basically analyze the tech companies? It's, as I said, all my experience, I've cut down to 3 things. One is the quality of management. Quality of management has to be very good because 90% of my losses is because of bad management. They have a vision, they are very focused, and that's the most key thing in any investments. You know the quality of people who are running the company. And then the second thing is the quality of assets. Is the asset good? Is the asset, like in mining, in mining you look at the quality of assets, what the deposit is. In technology, you look at the platforms. You look at the IP. you see if there is a scalability. Because the quality of asset is good, then the revenue will flow in. Is it scalable? And it's recurring revenue. That is, they have a revenue coming in like a subscription every month, or so recurring revenue. So there's a quality of good revenue in that. And is it disruptive to traditional businesses? Like it's going to disrupt, just like when the internet came in, most of the newspapers got disrupted because we got Seek.com, carsales.com, realestate.coms. They become prominent. In AI, which are the ones that will come up? That's the key, if you pick up those ones. And the final point, which is really important, is the growth going forward. I'll just give you an example. 2 years back, 3 years back, after the COVID, everyone thinks the batteries were the big thing, the battery minerals. And they thought nickel was going to be very big. So we picked up a good management, we picked up good quality of assets, but then the nickel prices never went up. It started coming down. So most of the companies struggled for the last 2 years. So going growth forward is the most critical thing. That is there a demand going to go forward? And the quality of management is really important, because if the quality of asset is good, and eventually growth will pick up. So if the management stays focused and stays resilient, then you will see the companies going up. So that's the critical part. So, so where do we come in? What's my job? What's my role? Basically, because Australia is the place where plenty of small cap companies float in the markets, and they need capital to grow. So what we do is that and capital is limited, and the capital goes to the best companies, optimized capital. That's our job, to ensure that the investor capital is optimized. Optimization. So capital allocation. So basically we help connecting the right companies with the right investors. And usually you get rewarded. And basically the second is that we constantly communicate with the management. We have to know the management is focused. They are delivering what they promised to the investors. And the third thing is that you have to do the due diligence on valuation side, on the streamline side. So that's what we come in. So the last part, we raised capital for the last 4 companies. Joe helped for Control Bionics and Pontera 3D. They were the lowest price in the market last year. We raised capital for them to grow the business, to get new contracts. And Karmaco was one of the management was really focused on that. So we helped Karmaco as well, and AUMake as well. So if you have any questions, you want to know more about us, there's a stall by Joe. I've got my card, so if you want to take any deals down the track, we can send it to you. And you're most welcome to ask any questions. Thank you.
Thank you so much, Naveed. Appreciate your time this morning. You can jump off the stage there, buddy. You jump off the stage in some direction. You good?
I wanted to have the speaker with me, but I didn't have it, so I can stand here.
All right. No, I understand that completely. What I should have done, perhaps given you my microphone. That might have been easier.
Yeah.
Hey, tomorrow we'll organise that one in Melbourne. Will be perfect for the kickoff. Could you please thank Naveed again, everyone?
Thank you.
Now, just again for my presenters that are in the room, it is a little bit different because I'm not up on stage with you normally, and I realised that my bell was actually up here. So with 2 minutes to go, I'll ring the bell. I'm going to go and sit back down the back there. So Liz, you're first. I think. Oh no, Liz is second up, aren't you? Glenn Corrie. Glenn, where are you in the room at the moment, mate? Are you down the side there? So Glenn's going to be our first speaker. So he's going to be our crash test dummy up here on stage today. So with 2 minutes to go, I'll ring my bell, and with a minute I'll stand up, and then I'll come and stand next to you and see if I can get close enough to you on this skinny stage. We're going to be Olympic athletes, don't we? You can take that one up there. So let me tell you a little bit about our first presentation for you up on stage. So we're going to the forefront of clean energy solutions, and the group's name is Hazer Group. So they're a leader in low emissions, clean hydrogen and graphite production with a mission of driving decarbonisation efforts right the way across the energy sector. So they're led by this fellow I've introduced you already. This is Corrie. He's their MD. He's got 25 years of experience across the traditional and also the renewable energy sector. And I have a feeling you're going to see a little bit about how some of the qualities that Naveed described when he got up and said to you, this is how you identify a tech stock that is worthy of having in your portfolio, and you're going to see some of those qualities. One, we've got the resources portfolio, which is already brilliant. Now, how are we adding tech into that to make it even more so for you as an investment potential? Would you please make Glenn very welcome, everyone?
Thanks, Christina. Oh, hello. Thanks, Christina. Not sure about the management, but I think we've got pretty good assets. All right, I'm going to jump straight in because we're on a time clock, but Hazer, for those of you who are not familiar, stands for Hydrogen and Zero Emissions Research. That was the vision of the company about 17 years ago. That's the reality of the company today. We've developed a very disruptive, low emissions hydrogen production technology that is getting very serious attention by a lot of customers in the world today. I'm going to start by setting the context in terms of the market. Today's hydrogen market, for those of you that are not familiar, is about 95 million tonnes per annum, okay? To put that into context, it's about a quarter of the LNG market. The LNG market, it's about 400 million tonnes, but the hydrogen market is valued at about $180 billion, whereas the LNG market's valued at about 120 billion. So it's about a quarter of the size, but it's significantly larger in terms of value, okay? Hydrogen's used for two things today. A lot of people don't appreciate how big it is. Every refinery in the world has a hydrogen production facility. Every ammonia and fertilizer facility in the world also has a hydrogen production facility associated with it. The problem with it is all of that hydrogen, that 100 million tonnes, is dirty hydrogen. Every tonne of hydrogen produced today is associated with 11 tonnes, yes, 11 tonnes of CO2. So it's actually producing more CO2 than it is producing hydrogen. That's the disruption for Hazer. That's the opportunity, but that's the problem for industry. So we're really excited about the space that we fit into. All of that is steam methane reforming, okay? And that's the technology that we're looking to disrupt. So what does Hazer do? Hazer effectively is decarbonising gas, okay? We take any methane-rich feedstock or gas, biogas, LNG, pipeline natural gas, wastewater treatment gas, 25 times more harmful than CO2, and we effectively convert it into, or split it into pure hydrogen and high purity graphite with zero emissions, okay? So we're already beating the existing incumbent technology. The X factor on the company and the intellectual property is the use of a catalyst, an iron ore catalyst, okay? That drives down the process temperature that we operate to significantly lower than all of the other operating processes and technologies that are available in the market today. We do this reaction at about 700 to 900 degrees. Everybody else is doing it at north of 1500 degrees Celsius. That drives out a very low cost hydrogen production process that can be very competitive in the market relative to the incumbent technology today. One technology that serves three very valuable markets. The hydrogen market, growing at 6% per annum. The graphite market, which is also growing at that sort of level, and overall decarbonisation, okay? Here's a bit of a snapshot in terms of the production technologies. We talked about Hazer, so natural gas feedstock, lots of hydrogen, lots of graphite, low carbon intensity, low energy intensities, available today, commercially viable today. Steam methane reforming, that's the incumbent technology. It just loses on carbon intensity, 10 times the carbon intensity to do what we can do with zero emissions, okay? Electrolyzers, often referred to as green hydrogen. You've heard lots and lots about green hydrogen. We are not green hydrogen, but green hydrogen takes a huge amount of energy. What green hydrogen does is it splits water relative to splitting gas. It's 7 times more energy intensive to split a water molecule relative to splitting a gas molecule. And this is the principal reason why green hydrogen projects are struggling in the market to get commercial viability, just purely because of the energy required to split water relative to splitting gas, okay? We plug in. Think about any refinery, any power station, any LNG facility, any steelmaking process. We plug our technology and drop it in and provide hydrogen at the use point and the demand center for the customer today. Okay, so we don't transport hydrogen around the world. We literally have a process that plugs in and it can provide hydrogen to the customer immediately for use in their facility. Here's the most exciting bit about it. It's the cost picture. Everyone talks about the levelized cost of hydrogen. We can deliver hydrogen to the world for anywhere between 50 cents in the US and up to about $2 to $3 a kilogram in Asia Pacific. Why the difference? Because the feedstock prices are different around the world. In Asia, gas prices are slightly higher. Even then, we can deliver hydrogen at a very affordable cost for customers, very similar to the cost of the existing feedstock. So that's the willingness to pay is very high. And this drives out very high margins for customers, and it also drives out very attractive economics. And it's one of the principal reasons why a lot of the hard-to-abate customers are picking up our technology. We've done this for 17 years. Okay, so we're not a new technology. We've plowed $110 million into developing our technology over 17 years. This is the 5th successful scale-up of the tech. It's the commercial demonstration plant. It's sitting in Perth in WA. It is going very well. This is the final phase before we take our technology commercial. We are effectively demonstrating that our technology works on a continuous basis at an industrial scale. That's what a demonstration plant's about. It's proven tech. It's about now optimizing it and readying it for commercial deployment. You can see the customer base here. We recently just announced that we've gone through 180 hours of continuous operation. We've got further milestones ahead of us, and we'll be declaring commercial readiness for the tech throughout the year, probably closer to the end of the year. We have a rapidly growing footprint of customers around the world. You can see we've got target markets, North America, Europe, Asia, some of the world's largest. We have had due diligence by all of these groups for the last 2 or 3 years on our technology. I like to say we're walking or running and chewing gum at the same time, because we're developing a tech, but we've got demand for it that is already there, despite the fact that we're still only TRL 7 going to TRL 9. And that's a beautiful place to be, because that means that we're going to accelerate the pathway to revenue for the technology. But you can see the quality of the partners that we're getting. All of them are in hard-to-abate sectors that are very difficult to electrify, that see value in the decarbonisation potential of Hazer's technology. We've got engineering groups, we've got technology platforms that are also working with us to help us accelerate the tech. More interestingly and probably exciting is behind all this, we've got no fewer than 30 to 35 commercial discussions with prospective customers, strategic partners like engineering firms that can help us accelerate the tech to market, but also strategic investors at the corporate level. I think I'm losing that, yep. Corporate level as well as at the project level. So a raft of strategic partners and customers that are seeing value in their technology. We just recently inked a deal with a very large gas utility in Canada. This takes us one step closer to a very serious revenue stream for the company. Fortis BC is 2 times the size of Origin Energy. Okay, so it's a very big gas utility that is looking for a solution for refining to effectively replace steam methane reforming. We've now got a license fee framework agreed. We have got early access also to revenue, which will start arriving this quarter through our engineering service agreement. And that is a unique opportunity for us to get early access to revenue for a technology that is effectively taking an FID in 2025. So it's a really exciting project. It's a 25 times scale up on our existing facility. POSCO, you've all heard of POSCO, big company, big industry, massive problem, okay? Steel making is responsible for around 10% of global greenhouse gas emissions or carbon dioxide emissions, okay? POSCO is the 6th largest steel maker in the world. They've chosen our technology to decarbonize green steel. They're developing a clean steel, low emissions process called HyREX. We're now jointly developing the integration of our technology into green steel. This is transformational for not just the steel industry, but also Hazer. It's potentially a scale that could be up to over 200,000 tons per annum of hydrogen demand. So it's a very sustainable long-term partnership that we're very excited about. And as a licensor of a technology, this could be very serious cash flow for us in the future. Graphite, the other side of our technology, hydrogen, of course, and graphite. We've got a very unique graphite product. It's very high purity. It is low ash, low sulfur. It can fit into any steelmaking facility. There's 7 applications for Hazer graphite in steelmaking. Water purification, carbon black applications like tire manufacturing, asphalt, bitumen, thermal energy storage. I could go on. But the point is, graphite's a critical mineral, okay? Of the 10 critical minerals that Australia produces today, the one it doesn't produce is graphite. Okay, so we're getting a huge amount of inbounds to develop a synthetic graphite market for not just the Australian economy, but also global economy. And 90% of the world's graphite comes from China, and they've recently threatened to step on the hose. So this is a growing market. It's a diversified earnings base for us, being hydrogen as well as graphite. So, another potential value kicker for us, up to potentially $1,000 a ton for Hazer graphite. So if you put that into a model, you can see just how much value it can create for Hazer. We're a licensed model. We don't take project level risk. We don't take CapEx risk. We literally license our technology like Microsoft to customers. Okay, that accelerates our access to free cash flow. As we start licensing and collecting license fees at FID and beyond, this is a cash machine that will effectively start throwing off large scale cash as we develop our portfolio throughout the coming years. Buckle up, we have a seriously busy 12 months ahead of us. We've got more milestones on the CDP. We're calling commercial readiness by the end of the year. Our project in Canada will receive very shortly early revenue through our engineering service agreement, and we'll finalize the license terms, which will give observers of our company the true underlying value of the technology. And that's what they're looking for, and that's what we're going to deliver in terms of the visibility on the scale of this platform. Okay, we're valued at $70 to $80 million today, but if you plug all of these numbers into a model, every plant that we will operate or not operate, but we will sell, could potentially deliver $50 million of underlying NPV to the company. That's what a license model does. So it's not hard maths to say, well, you've got 10 projects. This could easily be a $500 million to $1 billion platform at scale. Okay. Japan, there's more milestones there. Again, license terms that will give visibility on valuation. I'd be very disappointed if we haven't converted more of those 30 projects into real commercial agreements again this year. We've got 4 foundation customers. We've got a bunch of commercial discussions going on, and we're looking forward to converting some of those customers to real license agreements. Corporately, we're in a very good shape. We've recently raised, so we've got a strong cash position. We're robustly funded. We've also got line of sight to a fairly sizable R&D rebate. There's my warning. And we have a number of other non-dilutive inflows ahead of us. We've got more government funding that's announced. We're in the running for some other federal as well as state government grants to support the technology and the growth of our company. So we've got a long runway that's well funded. We've got some significant milestones ahead of us. Our valuation is not where we want it to be, but we think that's an opportunity for folks to invest in the company. It's a compelling investment opportunity. It's differentiated. Okay, you've heard lots about hydrogen. We are not green hydrogen. We are a very unique technology that is being picked up by serious customers that have done extensive due diligence on our technology worldwide. And that will continue to grow as we fine-tune the technology and ready it for commercial deployment throughout the year and into 2025. I've got 45 seconds left. I'll pause there. Thank you.
Glenn, Corrie, you didn't have to pause there. It's your 45 seconds. Does anyone have a question for Glenn that you'd like to throw out? I'm happy to run across with the microphone.
Hi, you mentioned that you've got a special catalyst that you're using for the conversion. Is that patented, that catalyst and that system?
Very good question, yes. It's the intellectual, we've got 4 patent families. Most of it's sitting on the catalyst, actually, the use of iron ore as a catalyst. It's cheap, it's abundant, of course, and it's one of the reasons why this technology is very competitive. We have 4 patent families. We've got over 60 patents worldwide that are being granted or impending in over 32 jurisdictions around the world. Nobody can do this, and nobody can produce hydrogen from methane pyrolysis using iron ore as a catalyst. Very good question, though. Our patent family is actually very public, so you can see it online. Yeah.
Glenn, we'll leave it there. Thank you very much, everyone. If you want to speak more and want to know more, the beauty of this conference is that all our presenters are here, so take the time to go out and have a chinwag with them.
Right. Thank you.
Thank you very much. All right. Do you like my bit of technology? It just died. There you go. I'd like to point that out. Luckily, I know a lot about our next presenter, so while Liz Dallimore makes her way up to the stage, I can tell you a bit about that. For those of you who have just joined us at the back, there are a number of seats down here. I'm happy for you to come down and have a seat so you can settle back and listen to this with more interest. That is James, everyone, who is our audio tech. Please make him welcome. Big round of applause for James. He's been working feverishly to do everything out the back. Give him a round of applause as he goes back, please. So one of the roles that I have, and I'm not sure if you've seen it or not, but there's a new TV show on Channel 9 Australia. It's called Innovation Nation. And Innovation Nation, I suppose, to encapsulate it, is a bit like the old Beyond 2000 that we had back, when we were all in our 20s, etc. And we love to see what was coming up in the world. And this year we started off with a new show and we profiled 64 companies. And Liz's company, the company that she's involved in, Argenica Therapeutics, was one of them. And there's a good reason for that. There's been a lot of buzz in our home state in Western Australia about what Argenica has managed to achieve, I say achieve at this point in time, in stroke. So I'm sure many of us would have been touched by someone in our family or our friend group who has suffered from a stroke. What can first responders do to prevent this thing that's called this cascading of brain cells being hit? One gets hit by another, gets hit by another. Is there something we can do? Liz's company and her passion, her drive for innovation may have found a solution, and it's causing a huge stir. It's got all the media talking in our home state, and I hope it has you talking with others, but also in your investment portfolio, thinking, is there potential there for you for growth? Please make Liz very, very welcome and enjoy this conversation.
Thanks. Thanks so much, Chrissy. I do note that the timer started a minute and a half ago, so I'm going to take an extra minute and a half at the end, if that's all right. Great. So it's so great to be here. I think this is my 3rd TechKnow conference, and I love it. I think the story that we have to tell at Argenica is an extremely compelling one, and I think one that really touches on not only the investment potential in what we're trying to do, but I think also the emotive side of what is neuroprotection and neurological injuries, which, as Chrissy pointed out, I think probably at some point in our life does touch us all. So just a quick disclaimer. So I'm going to talk to you today about neuroprotection. Neuro being the brain, and then we all know what protection is. So our lead drug candidate, known as ARG-007, is essentially, it is a drug that is able to protect brain cells following injury. Our lead indication is ischemic stroke. This is a huge unmet need. So 1 in 4 people in this room will suffer a stroke in their lifetime. It is absolutely massive in terms of the unmet need and that opportunity that we're going after in stroke. So we are in a phase 2 clinical trial in that indication. The way that the drug works, it has multiple mechanisms of action, and I'll try and explain a little bit about the way that the drug works. But this multiple mechanism of action in neuroprotection actually then lends itself to a number of other neurological conditions. So we have data in traumatic brain injury, both severe TBI, so we're talking about traumatic brain injury suffered, say, post a motor vehicle accident, domestic violence, king hit, those types of severe TBIs. And we're also looking then to expand that into concussion, so really relevant in terms of sporting injuries. We are quite progressed in an indication known as hypoxic ischemic encephalopathy. This is a newborn infant condition where it generally occurs when the cord is wrapped around the baby's neck during childbirth. And so you're blocking blood flow to the brain through the restriction of blood flow through the carotid arteries. And these poor children suffer horrendous neurological and functional deficits following this brain injury. But what I love about this company is the science that it is built on. So this drug has spun out of a research institute in Perth known as the Perrin Neuroscience Research Institute. That institute punches above its weight. It's already had 3 FDA-approved drugs that have come out of that institute. So we're hoping that this is the next drug out of that institute that will get regulatory approval. But it is based on a decade of work that's happened at that research institute. So we're now up to 26 peer-reviewed publications. So if you love science, if you've got a science or medical background and you want to dig into the science, we have huge amounts of data available that you can look at. But that puts us in good stead when we're actually talking to potential large pharma companies, because they can do a lot of work on not only how the drug works, but how effective it is and how safe it is. And we also now know, we have data to show that the drug is safe in healthy volunteers. So just quickly looking at where we're sitting as a company. So we raised 12 million a couple of months ago. We raised that money at 52 cents. Share price went up to 98.5. So if you came into that placement, you've done very well in the company. We have drifted back down, but we are sitting at around 100 mil market cap. We listed the company 3 years ago. In June 2021 at a 15 mil market cap. So we've generated significant value for shareholders to date, but there's so much value still in this company. That stroke market that we're going after just in the US is worth, just for the indication that we're looking at, where no one else is playing, is worth $5 billion a year minimum. No one is in that market. That is the market potential that we are looking at. We've also been really successful in attracting grants, so both federal government grants, WA state government grants as well. So that's close to $5 million of non-dilutive funding, and we'll continue to apply for those grants. So quickly just getting into stroke and what we're talking about here in terms of neuroprotection. So when someone has a stroke, they have a clot in a blood vessel in the brain. So that is the thing that causes a stroke, and obviously then the functional outcome of that patient is what we typically associate with stroke, so drooping face, paralysis on one side of the body. Brain cells last for about 3 seconds before they start dying once a clot is lodged in a blood vessel in the brain. And essentially what happens is you get an upregulation of a neurotransmitter known as glutamate. That glutamate starts flooding the space around the brain cells, and it causes all these little channels on the brain cells to open up, and calcium starts flooding into those brain cells and causes those brain cells almost to implode on themselves. Once one brain cell implodes, it releases more glutamate, and the cycle just keeps going. So you get this kind of cascading out of brain injury, and we can see that on the imaging in these stroke patients. So what our drug does is it blocks those little channels. It actually takes those little channels and pulls them into the cell so that there's no ability for that calcium to flood into those brain cells and cause that implosion. So we sort of think about it as actually hibernating the brain cells and essentially buying that patient time to get the treatment that they need. This is a bit of a technical graph, but what we do within our lab is we look at all of the competitor drugs, and there's actually not that many, there's only a handful. I can count them on one hand that are actually in the clinic looking at this exact problem. And what we know, we have the only drug globally in the clinic that blocks those calcium channels on brain cells. So we're the only company that is actually able to achieve this in the world. Every other company that's in the clinic is looking at things further down that brain injury pathway, so inflammation, edema, those sorts of things. But we know with our drug in our preclinical work that if you stop that calcium influx, you actually don't get all those other associated things. So we globally, we are the leading company addressing this problem, which is hugely exciting. So in terms of what we've done to date, so what the preclinical studies show in a model that really reflects a clinical setting in humans is that we're able to reduce brain injury by 70%, which is massive. So think about the functional outcomes of those patients. If they get 70% reduction in brain injury is huge. We know that the drug is safe to administer in ambulances. It doesn't exacerbate bleeding. We know that it can be given with standard of care drugs. So in drug development, that's hugely important. You cannot be developing a drug that may have an impact on another drug that's already used as standard of care. So the drug that's given to stroke patients is a drug that dissolves the clot. It's called a lysis drug or TPA. So we know that our drug doesn't have an impact on that drug, and nor does that drug have an impact on our drug. And as I mentioned, we have undertaken a phase 1 clinical trial, so we know that the drug is safe and well tolerated in humans. One of the things to point out, to get a neurology drug approved, the biggest hurdle that you do need to get over is safety. So unlike oncology, where you're actually developing a drug that you want to be toxic, in neurology, you need to prove that the drug does no harm. So this is the biggest hurdle that we need to get over. For a large unmet need like stroke, where there are no drugs on the market to protect brain cells, the hurdle around the efficacy, so how well that drug works to get that drug approved and on the market, is actually relatively low. So if you look at any of the recent approved Alzheimer's disease drugs, the efficacy is reasonably marginal, but the FDA wants to get these drugs on the market. They want people to start using them. They want to see then other drugs come into the market that actually can beat that efficacy. So the hurdle for efficacy isn't huge. What we're really focused on is safety. The drug can do no harm in stroke patients. So that leads me to our phase 2 clinical trial. So we have announced last week that we have dosed 20 patients in that trial. The youngest patient in that trial is 45. The average age of the patients is 70. So we're not talking about a really old person's condition here. We actually had a gentleman come in who was 32 into that trial. His parents decided not to consent into the trial, is absolutely fair enough, but we're not talking about an old person age-related condition here. So what we are doing in this trial, so when someone suffers a stroke and the paramedic arrives, the first thing is to get them to hospital as soon as possible. So you need that stroke diagnosed via imaging, and the only way that can be done is in hospital. So when the patient comes into hospital, we start screening them and looking, are they eligible potentially for our clinical trial? Once we have the scan and we know it's a clot sitting in a large vessel in the brain, and that patient looks like they'll be eligible for our trial, then we will, not me, but the neurologist and the stroke care nurses will administer either our drug or a placebo in that trial. That patient will then go to a standard of care procedure known as a thrombectomy. So this is the mechanical removal of the clot. So a shunt is put up into the groin, all the way up into the brain, and a neurointerventional radiologist will aspirate, suck out that clot. That's a really key element of the clinical trial design that I probably don't have time to go into, but really what we're trying to do is also, you get a secondary injury post that thrombectomy. That procedure is much better than leaving a large clot in your brain, but you do get this reperfusion or secondary injury. So we're hoping that our drug will also protect against that. But first and foremost, we are testing the safety of our drug in this trial. So we're looking at mortality rates, we're looking at if there's any adverse events. We need to prove that our drug does no harm to stroke patients. And then as a secondary endpoint, we are also looking at how well is the drug working at actually reducing that brain injury. So we'll look at that on imaging either MRI or non-contrast CT. So in terms of the trial itself, we are activating 10 hospitals in Australia. We are only doing this trial in Australia. Australia is extremely well known globally for running these types of stroke trials, and the neurologists are absolutely world class. It is a double-blinded study. So that means that we don't know, no one knows except a couple of people, whether the patient is receiving a placebo, so a saline IV infusion, or our drug. That's really important in clinical trial design, to keep it blinded so we don't introduce any potential biases into the study. And then we're looking at these acute ischemic stroke patients where they've got a clot in a large vessel in the brain. So these are the most severe types of stroke that result in the biggest types of brain injury. In terms of where we're sort of sitting at the moment, so we're recruiting 92 patients into this trial. We are now at 20. Those 20 have been recruited in only half of the hospitals that have been activated. So that's in 5 of the hospitals, and that's happened in 4 months. So we are well ahead of our recruitment target, which we had initially thought was the end of next year. But this time next year, we expect that we should have pretty much the majority of that dosing done. We now have 8 sites activated, and all 10 sites will be activated by the end of this week. The next real sort of milestone then is looking at 23 patients, which we're pretty close to. And throughout the trial, we're always looking at safety. So whilst it's blinded, we are just making sure that there's no particular patient that may potentially be having a safety issue that could be related to the drug. So I just want to quickly touch on, I'm adding an extra minute, yeah, is that okay? Okay. Quickly touch on the other indications. So the value of the company at the moment, that 100 mil market, all the value really does sit in that stroke indication, but we are progressing other indications, as I mentioned before, so TBI, HIE, and also Alzheimer's disease. The TBI data is starting to look really, really compelling. So again, there are no drugs, no therapeutic drugs on the market that can protect against brain injury in TBI. 69 million people globally suffer a TBI that warrants them going to hospital every year. So you think the $5 billion stroke market is big? The TBI therapeutic market is absolutely phenomenal. So we have got some really compelling data, not only in rats, but we actually moved into a more relevant model in ferrets. As you can see there, the brain of ferrets is a lot more realistic in terms of how it relates to humans. And what we look at in the TBI, so a lot of the injury actually happens in the hippocampus. So you get protein aggregation in the hippocampus, which can then lead to, later on in life, dementia, Alzheimer's disease. It's really the accumulation of proteins in this area. And so what the data shows us is that it's really working to reduce that protein aggregation in that key region of the brain back down to normal levels, which is phenomenal. So over the next 6 months, we'll be generating a lot more data in TBI and looking at options to take that into the clinic. I'll just quickly go forward in terms of, so HIE, this infant condition I mentioned at the beginning of the talk, this is actually a rare paediatric condition. We've got, again, some really compelling data, and we're doing larger animal studies really just to de-risk the drug asset as much as we possibly can before we take this into the clinic. But what an orphan indication comes with is the potential to get a lot of incentives. So we have orphan drug designation and rare paediatric disease designation for HIE from the FDA. So it means we get 7 years market exclusivity, we get tax credits from the FDA, we get priority review of our clinical trials, and if we're successful, we will get a review voucher, priority review voucher, which we can sell to another company that is north of $100 million US. So that's what those vouchers are valued at. So really exciting near-term catalysts in the next 6 months. We've got a lot going on, so keep an eye out for our trial results and our pre-clinical data. Thank you.
Thanks, Liz. Brilliant. Off you go. Are there any West Aussies in the room besides myself and a couple of us? All right. So you will know, you've heard of cash converters, cashies, as they were fondly known to us. They started with one shop front back in Perth in the 80s, and Fast forward 4 decades, they're here today presenting to you at a leading tech conference. Why is that so? Well, the perception of cashies has changed because it's strategically and aggressively adopted and wrapped emerging technology around its business model. And today, it boasts an impressive market cap. It pays a dividend. Should you have it in your portfolio, I'd like to introduce you to MD Sam Budiselik, who's going to update us on the investment opportunities for our favourite cashies. Please make him welcome.
Thanks, Chrissy. Thank you for listening to my presentation today. I'm really excited to represent cashies. I think it's a story that's been around for a long time. The business has been operating this is our 40th year. And originally we started as a store retail network, buying and selling items and loaning against those items, secured against a piece of collateral. More recent years, we've really set up a very sophisticated personal finance business, offering unsecured personal loans to our customers. And over that time, we've really developed our online platform, offering all of our retail inventory that's in stores nationally and shipped from the store nationally to any buyers online, and our personal finance business operating online and in stores as well. And I think as we've moved forward, the store format, business model and entire operations just really changed over that time. I wanted to show a brief video of one of our stores, just showing a different retail mix now, higher value, luxury items, handbags, jewellery, electronics, mobile phones are the big categories selling now, probably less of the traditional inventory that you might expect if you walked into a store. This is our new store in Sunshine in Victoria. Quite a looking feeling here. So Cashies it's a business that stood the test of time. It offers a very important service to our customer base and our part of the economy that we deal with. I think really our purpose, we've always been facilitating what is now referred to as a circular economy, repurposing items and buying and selling and trading in a safe, high street, trusted, listed, big brand way, and have a lot of customers that trade with us daily. The second part of the main sort of focus of the business these days is providing personal finance solutions to customers that would otherwise not have access to mainstream banking. And really, we can only do that by leveraging our technology, because we can't rely on traditional credit bureaus. We have to build our own very detailed profile of a customer, provide the data to our credit models and train our own credit models. And we're very self-sufficient in the way we assess our responsible lending focus and our credit risk approach. By having more and more data and scale, you can continue to become more sophisticated. And really, we're really trying to take that technology to lower borrowing costs. I mean, unsecured personal finance to our customers is a high loss business, and the more we can reduce losses, the more we can pass through those benefits to this part of the economy. Really, our business model, we've got store networks running where in Australia, New Zealand and the UK, we own some of those stores. We refer to them as corporate stores, and we operate a franchise model as a master franchisor. In other parts of the world, we've licensed our brand to partners who operate our business model. But we have a lot of transactional data washing through the business, and we get 40, 50,000 applications a month through our finance business. So we're taking a lot of data, we're loading a lot of bank statement data, we're building a very detailed picture of this part of the economy, and it's helping us risk customers and also interact more closely as a result. Obviously, online and store are complementing each other too. So the technology really that we focus on not only is a world-class retail site, world-class lending site, Under the hood, the credit risk models that we've built are, 6 generations now over about 8 years of refining those credit models and feeding them data and deploying machine learning. And a lot of the proprietary technology we've built around valuations and inventory management is really unique to our business. And we've got the retail buy-sell, like I said, the pawnbroking, the personal finance business I'll talk about in a minute, small, medium loans and line of credit, and our franchising income streams. So as I mentioned, the global network, we focus on Australia, New Zealand and the UK as our big engines. And then we've got franchise partnerships, really the model spread around the world, very, very big in Europe, Southern Africa, parts of Asia, and obviously UK. And there's some market cap stats there and revenue numbers that we've put out through an unaudited trading update recently that's available on the ASX. But we have paid 2 cents per year with revenue of around 380 million expected this year. As you saw, hopefully in the video, pre-owned retail really is changing when you're walking into the stores now, smaller sort of footprint store concepts, higher value items. We're just in the process of opening a luxury store in Bondi. That will be available or open end of August. And we've got a similar store in Paran in Melbourne. So, they're in those higher affluent areas, and we're seeing a lot of that pre-owned handbag and clothing sort of lines coming through, watches and jewellery. Our finance customers, were a big part of our business is focused is obviously large and growing. I think as people are, suffering cost of living pressures, there's a demand for finance that isn't being met by the banks. So as a big non-bank lender, our credit distribution is really, in a traditional sense, sub 500. So we would deem that non-conforming or sub or near prime borrowers that are coming to us. Younger people looking for a small, loan, $2,000, $3,000 to acquire an item or take a holiday or fund a medical expense. The actual overall market in Australia is huge. There's nearly 4 billion of finance demand out in the market per year. Our small, medium and a new line of credit products are designed to provide customers an option and to provide flexibility over time as they build a profile with us to reduce their borrowing costs. The small loans we're moving away from, we've released a couple of new products and really started to change the shape of that finance business. So I think really the opportunity with Cash Converters is to continue optimising the business as with the scale brings an opportunity to continue innovating. We're releasing new products, we're diversifying our loan books, we're growing our actual store footprint. In Australia, we've got 150 stores, that could probably go to about 200, and growing our international network. And realising value is really, I think as we've repositioned the business and moved away from smaller loans that, were higher margin but higher loss, we're just changing the revenue composition of the business and positioning ourselves for the future. In terms of financials, the business it's a big business dealing with over 600,000 customers in terms of just transactional interaction, generating revenue of 382, predominantly from the retail operation and the lending business. About 2/3 of our earnings are coming through the lending business. The rest is coming through the retail buy-sell. We've built a gross loan book of $300 million now, which is really the average $2,500 loan product. So 100-odd thousand active loan customers, a big loan book full of lots of customers, and a reasonable sized store network now and growing. And we have been paying a dividend. We've paid 1 cent per half for the last 7 halves, with a decision pending for August as well. And our revenue growth profile now is, I think, important because of the changes the business has undertaken through COVID and repositioning. It's really now set to continue growing. And I would hope that we would see that operating leverage starting to feed through now and earnings starting to increase as well off the back of a fairly choppy few years with that COVID period mixed in. We'll see our small loan product falling, our medium loan product growing, new loan products coming into the market, and hopefully sort of we expand our customer segment too as we offer lower cost, more flexible lending options. With our strategy and outlook, we have an opportunity where with half of the store network in Australia franchised and about 3/4 of the store network in the UK franchised. We can acquire the franchise stores back, and they're a good use of our capital with the stores sitting on our point of sale and lending platforms, branded cash converters. The staff transfer across to work for a corporate operation when the stores are acquired. We're paying in between 3 to 5 times EBITDA for those store acquisitions based on our numbers, understanding the top line revenue of the operation, putting a corporate cost overlay. We can pretty accurately price the stores and fold them into our existing operational and management infrastructures. And the more of the stores that we fold in, it just allows us to then take greater control over our product and our distribution and our marketing as we work to defranchise the network. So there's a good opportunity there to really just acquire earnings in a relatively low risk way for our business. We are also looking to continue growing our loan books into a growing market segment. Currently 3 million odd Australians estimated financially excluded. It really is growing as the banks are walking back their risk appetites, and they're assessing criteria getting stricter and stricter. It provides us an opportunity to play in a space that's growing. And I think with our size, with our scale, with our technology, we can compete against the other non-bank lenders, and we have shown that and built a really solid lending business as a result. And reducing our loss rates and diversifying our loan books is really what we're focused on in the finance business now. And obviously balance sheet strength. We're fairly conservative with the way that we deploy our capital. Remain committed to trying to return to shareholders who have supported us on the journey, and continue paying a dividend as a result. Thank you for listening.
You caught me on the hop for my little table down the back. Thank you very, very much. If you've just entered the room, we've got a couple of seats down the front here. You're more than welcome to come and barge away, and the team at this table are quite nice, I assure you. Aren't you guys? Not bad down here. Our next presentation is coming from James Hill. James is the Chief Operating Officer at Singular Health Group. So we're going to hear how a West Australian technology company is breaking into the US medical imaging market and modernising the way that medical images are digitised, analysed and shared using 3D visualisation and also AI. Would you please make James very welcome?
All right. Good morning all, and thank you, Chrissy, for the introduction. It's great to be here at TechKnow Invest. I've been the last couple of years as a spectator. Great to be back as a presenter. Before we get into something about Singular Health, I think it's important to understand exactly the kind of analogy of what we're trying to do. Now, 23 years ago, Apple came out with the iPod, 1,000 songs in your pocket. It was a way of digitizing and monetizing and mobilizing songs, and then with video with the iPhone. For us, it's all about mobilizing medical images. With Apple, 23 years ago, before they had the iPod, you had to walk around with CDs. You had glove boxes and center consoles filled with CDs with your songs, and it was hard to kind of digitize them and carry them around with you. Since they've been digitized and mobilized with devices like that, trillions of dollars have been unlocked through companies like Spotify, Netflix, Apple themselves. We are now 23 years later, and patients in the US are carrying their medical records around in their pocket on CDs. They do not have very stable or cohesive systems for transferring their medical records, and the whole system is quite fragmented. So our company is unlocking the full value of medical images and records by digitizing it and mobilizing it. So a quick disclaimer, our vision is to create a seamless and integrated healthcare ecosystem where the full value of records is unlocked, enabling universal access and promoting interoperability. Effectively, the Apple ecosystem, but for medical imaging. The full value of medical images They can't be extracted without being able to be digitized. You can't easily transfer them or access them without having them online and outside of CDs. And the interoperability and ability to share it rarely is being stifled in the US. So our progress towards this vision has been quite strong. In only 5 years, we've gotten a patent for our kind of proprietary 3D visualization technology. We have created a HIPAA-compliant file sharing system, which allows you to easily transfer your medical records in a safe, secure, and encrypted way. We obtained our FDA 510K clearance in the United States, and over the last couple of months, we've secured over 12,500 software license sales in the US as we've started to commercialize our technology and roll it out into the US. In terms of trying to work out which one's the laser. In terms of being able to extract the full value, as we start to digitize more images and get them onto our platforms, we are starting to integrate with AI models to be able to go through and extract the full value. So the current state of medical imaging in the US, every time you go for a CT or an MRI scan, they do it with a standardized file format. That file format is called DICOM, and it's the same file format the world over. It then gets stored in systems inside the hospital. We've all heard of ProMedicus, we've all heard of Mac 7 technologies. Those are the systems that store the images inside each hospital. But those hospitals don't typically talk to each other. And that's where we've got these silos that occur. And it results in American healthcare systems basically using CD-ROMs as their primary way of transferring medical records between facilities. That's costing facilities, including small radiology clinics, up to $1 million per facility per year, just in burning the CD-ROMs, mailing it out via registered courier to the patients, so that's all HIPAA compliant. It also means that because they don't access their images within a reasonable period of time, there's about $30 billion added in duplicate imaging in the US medical imaging sector, simply because you might have gone and got a CT scan a couple of weeks ago, you don't have it yet, you go to another hospital with another issue, and they'll scan you again. And finally, with the utilization of medical records, if you go in and you've got one particular issue, they're only going to look at a couple of images in that CT scan. There's a global shortage of radiologists, and that means that they're not extracting the full value. They're not able to get incidental findings, and they just don't have time to analyze hundreds of images. So our solution, we have created three kind of areas of IP. The volumetric rendering platform, which turns standard 2D images into interactive 3D models. A medical file transfer protocol, which is our HIPAA-compliant file sharing system, and we're working on a system called AI in the cloud, which will allow, kind of like the Apple App Store, people to bring in all of their different AI models to visualize and extract value from those images. And that's where, using 3D rendering and AI models, we're able to look at all of the slices in a scan, not just a couple. Our file sharing system, it can save facilities up to $1 million a year, as well as saving a lot of the duplicate imaging costs for insurers, providers, and payers. And our on-demand cloud storage, that reduces the duplicate imaging because we're literally putting the patient's medical images right there in their pocket with them. So why Singular Health? Our software makes it easier, cheaper, and faster to share medical images, medical imaging records, and puts the patient's images in their pocket and gives them the ability to take control over their own healthcare. So this kind of shows a little bit about the ecosystem that we are building. As mentioned, in the US, there's not a lot of connectivity between different facilities. So Hospital 1 and Hospital 2, they don't have a lot of interoperability. It's not in the interests of the electronic medical record companies to open that up and allow the files to easily be transferred. So Once we tie into their PACS network, doctors using our FDA 510K cleared software are able to download the images, and then they can share it easily within our system across online, like an online viewer, desktop applications and mobile apps, to patients, to other doctors, to insurers and billing coding companies. We work across a number of different applications. So we work across virtual reality, augmented reality, mobile, and we've just released a new software development kit which allows third parties to develop their own solutions on the back of our IP. A couple of market comparables. So we're down here with a market cap of about $20 million in a market worth about $66 billion a year. We're really looking to open up that value and not just be one of the kind of record labels or record companies who control the images at this point in time, but to be that cohesive marketplace that ties it all together. And the milestones to date, we've obtained all of the necessary regulatory compliances to market our product in the United States. We've collaborated with companies such as Sony, Schneider Electronics, and a South Korean medical AI company called Medical IP. Last year in July, we appointed a master distributor in the United States, in Florida. They are extremely well connected with some large organizations called managed service organizations in the US, as well as one of the largest healthcare providers in the US, HCA. We've received 3 strategic investments over the last year, all done at a premium, all coming out of the United States. So about 15 to 16% of our register is held by companies in the United States or entities in the United States who see the value in the tech, they've vetted the tech, they've seen us multiple times, and they're really interested in growing this. We've extended our intellectual property portfolio, and quite critically, we've started to work on an initiative for veterans in the United States. So why veterans? Well, upon going to the US, our master distributor is something known as a service-disabled, veteran-owned small business concern. So they're a company owned by someone who served in the Gulf War. They were injured whilst in the service of their country, as are about 22% of veterans. So in the United States, there's almost no one more sacred than a veteran. The interest is not just to have job security when you serve your country, but they make sure that there's a strong incentive to serve your country in the military by looking after you after you've come back to the States. To that end, Joe Biden passed the Promise to Address Comprehensive Toxics Act, which is effectively dealing with all of the veterans who have burn pit injuries since the Vietnam War. So anyone exposed to chemicals who's been damaged in the line of duty, they're able to apply for a whole number of benefits, including thousands of dollars of medical imaging expenditure each year per veteran. There's over 19 million veterans in the United States. As you can see on the slide, 4.2 million of them have service-connected disabilities and are looked after by the government. But once they move out of the active military duty and into the veteran affairs area, those two systems don't talk to each other either. So when they move from active military duty and then out into Veterans Affairs, they have to get their images back onto CDs, back into the Veteran Affairs sector, and tying into various private hospitals. So since January this year, we've sold over 15,000 licenses of the 3DICOM software across Miami, Texas, Nevada. We're working with a number of different community groups and organizations, veteran support organizations in the United States to grow that number in a kind of scalable model. And the United States healthcare system, it's $66 billion a year is spent on medical imaging in the United States. They spend over $4.5 trillion a year on their healthcare. That's 13,400, or roughly $13,500 a year per person spent on healthcare. And our software constitutes only 0.2% of what they would need to spend per person for insurance companies and providers to provide patients with our software and reduce those duplicate imaging costs and reduce those data transfer costs. There's also a strong appetite for patients wanting access to their imaging. So over 80% of patients want access to the imaging. It makes them feel like they're more in control, they understand what's going on more, but only 25% of them are able to get that. That still means that when there's over 80 million scans per year done in the US, that there's roughly 20 million CDs being burnt per year. And that constitutes at least an 80% saving in terms of the data transfer cost. Our go-to-market strategy, we have two kind of paths to market. One is through enterprise sales. We've appointed a number of sales partners in all different jurisdictions around the world. And we also have a direct consumer approach that allows patients to download our software online, upload their medical images, and once they've got them in that system, they can then easily share it to their doctors and care physicians. We also have a number of different revenue streams. So you've got software, recurring revenue, you've got a pay-per-use type model, and then we've got licensing opportunities through our technology. And managed service organizations. I briefly mentioned this earlier before, but in the US, their systems over there are very much managed by large groups called managed service organizations. So a whole hospital chain or an insurance company will actually delegate a lot of the management of expenditure to a managed service organization, who then are the ones who distribute or determine the disbursement of funds for the over 164 million Americans who are covered by employer-shared insurance. They're the ones who are looking to make cost savings. They don't want to be spending $10 per CD on data transfer. They want to be spending $2. They see it as a large saving, and they're the ones who have the ear of the CFOs at all of the large healthcare organizations. Finally, just running out of time, we are looking to develop the future of healthcare. So using artificial intelligence, we're able to extract a huge amount of information out of each medical image. We can go through and separate the human body from a number of, a single 2D grayscale image into hundreds of different anatomical structures, quantify the volume of them, determine whether or not that fits within a normal range, and use it to effectively triage or bring it to the attention of radiologists. Thank you very much, and we look forward to you joining us in unlocking the full value of medical images. Thanks.
Thanks, James. Well done. Our next investment opportunity at TechKnow went into a trading halt yesterday. They were valued at 16.5 million. They've opened up today, open for business, and they're increased already by 20%. To tell us more, I'd like you please to welcome Hussain. He's the COO of TrivarX. Now, they were involved in a phase 2 trial. Those results were what were released this morning that got everyone talking. Come up here, sir. Come and chat with us. Looking at the back there with these little bits of information. Now, the mission of this company is to innovate the connection between biological markers and mental health conditions. I talked at the start of the day about how we were perhaps not operating at our best today because we hadn't had that much sleep last night watching the Olympics. Long term, though, that can cause a whole heap more problems. So let's hear about these phase 2 trials, what they mean, and why is this company going so rapidly in an upwards direction. Please make Kai very welcome, everyone.
Thank you very much, Christina, and good morning, everyone. It's actually the company and my first time today at TechKnow, so very excited to be here and share the TrivarX story. Mental health is one of the largest healthcare issues globally. The World Health Organization estimates that nearly 1 billion people live with a mental health disorder, anxiety and depression being the most common. At TrivarX, we believe that an objective measure of mental health is the key to helping address this. So we analyse the electrical signals from the brain and the heart to identify mental illnesses. Our lead product, MEB1, analyses the data from a standard sleep study to identify depression at a sensitivity of over 85% compared to the standard of care, which is only 48% accurate. So we're a medical technology company headquartered in Perth, Australia, operations out of Minnesota in the United States. Capped at 16.5, Fidelity Investments is our largest shareholder, and our board is deeply experienced in commercialising medical technology and digital health in the US. So as Christina mentioned, I'd like to focus on our recent positive results from the successful completion of our phase 2 trial, which was conducted across 15 sleep centres in the US. We'll walk through how we got to this point in collating one of the largest repositories of sleep studies, labelled with patient mental health statuses, and what these significant results mean to us as a company as we look to take our lead algorithm through the FDA. We also have a unique near-term opportunity to deploy our solution into US sleep centres to address a problematic unmet need, but also an opportunity to begin expanding our technology into even larger markets that are desperate for an objective measure of depression and other mental illnesses. So within the US, 1 in 5 Americans today are experiencing a mental illness. 1 in 25 US adults are living with a serious mental health condition. However, more than half of these US adults with a mental health condition receive no treatment. Although we know there is a problem and there are tools available, mental health misdiagnosis in the US is rife. And one of the primary issues is that these tools are based around subjective assessments and questionnaires on how patients are feeling, what symptoms they're experiencing, and how they're coping with medications. Today, patients see physicians and typically undergo a patient health questionnaire, a series of 9 questions which are basically decided by a physician to assess their mental state. If they need further examination, they'll conduct a mini, which is a semi-structured interview. But both of these tools are purely reliant on both the patient and the clinician's interpretation of their symptoms. As such, we're seeing 50% of serious mental health disorders being untreated. Clinicians on average are getting the diagnosis wrong at 48% of the time, 1 in 2 times. And the misdiagnosis of serious conditions like MDD is 66%, social anxiety is 98%, and bipolar is 93%. That is a huge amount of the population getting the wrong information and the wrong care. So what is our approach? Our approach to addressing this problem is in sleep and its robust relationship with mental health. We know from the literature that 75% of people with diagnosed depression also suffer from disrupted sleep patterns. And at the most basic level, when a person is depressed, it's not just your brain, but it's also affecting your body. Your brain is telling your heart something, and subsequently your heart rate goes up. By studying patterns and physical biomarkers during sleep using AI, our team can now see, discover, and analyse things the human eye cannot see. So briefly about our scientific team, led by Dr. Archie DeFillo, our Chief Medical Officer, who spent 25 years as a practicing neurosurgeon in South Africa. As you can imagine, he saw a lot of incidents and a lot of surgeries, conducting over 3,000. He then took his career into research into brain and heart, and this has led him to becoming a truly world leader in the field of brain and heart signal analysis. Coupled with Dr. Massi Grassi as well, who himself has been working in AI for over 15 years before it was as prevalent as today. Also has a PhD in psychology and has been able to take his own clinical understanding along with Archie's to develop and code our suite of algorithms. So diving deeper into our technology, our process begins with extracting standard brain and heart signals before identifying a set of discriminating variables based on current scientific evidence and preliminary analyses. Using a supervised machine learning model, it is trained on comprehensive variables collected during our clinical trials. These variables that demonstrate statistical significance during testing are then converted into proprietary predictors. From our work to date, we've used over 60 predictors ranging across sleep architecture, REM, brain signal, brain frequency bands, staging, etc., which are further tested and integrated into enhancing the algorithm's performance. This process enables us to identify the presence or absence of mental health indications, and with larger training data sets, our model becomes more accurate. So over the last few years, we've collected and built one of the largest repositories of sleep study data combined with patient mental health statuses in the world. Across our clinical trials, we've compiled over 1,000 unique patient cases, 1,000 patient health questionnaires, each being individually evaluated by clinicians, and over 400 face-to-face structured interviews assessing cases of bipolar, panic disorder, PTSD, and the list goes on. So our first mental health indication we've trained our AI model on is depression. We're targeting this major market because 1, we know clinicians miss 50% of the time. 2, less than 2% of US adults are screened for depression at the primary care level. 3, there is no depression screening conducted in sleep clinics in the US. And 4, 21% of people undergoing a sleep study have depression. Our algorithm is the only objective depression screening tool for sleep centers. We are completely agnostic to different sleep hardware and software. We take a standard EDF file from a sleep study, we run it through our software, and we can accurately identify patients with and without depression higher than the current standard of care. We're well advanced, and off the back of today's phase 2 results and the multiple positive engagements with the FDA we've had to date, confident we can replicate our phase 2 trial in our pivotal trial, commencing by the end of this year, to complete the final checklist item to getting a de novo submission submitted by mid-2025. So this is our pride and joy as of today. We touched on earlier, we completed our phase 2 earlier this month. We enrolled 400 patients across 15 sleep centres. These patients were already referred for sleep studies for suspected OSA and other sleep disorders. We did not have to pay for these sleep studies, but simply engaged nurse practitioners to conduct the mini interview via telehealth right before the patients went to sleep. As you can see, our algorithm was able to correctly identify 87% of patients with depression, a specificity of 72%, PPV of 35%, and a negative predictive value of 97%. The key stat here as a screening tool to be widely deployed is in the negative predictive value, as this number signifies the likelihood a patient has depression when testing negative on our algorithm is less than 3%. Therefore, we are not missing any patients or any are falling through the cracks. So beyond the initial commercial opportunity of widespread sleep center deployment, our validation of the algorithm and these strong results now open an array of opportunities for us to explore. These results matter to us because we now have the clinical evidence and the conviction to go after commercial opportunities across 2 different axes. The first and natural fit is expanding indications. As touched on earlier, our database already contains other prevalent mental illnesses, and through our clinical and technological expertise that we've demonstrated on Med1, we can leverage our database and algorithms to develop objective assessment of mental illnesses. This can then allow us to move into long-term therapy management, long-term monitoring, which leads me to our second axis, which is moving to hardware that can be more easily adopted. We've started with in-clinic sleep labs because this is where the richest data source lies in type 1 polysomnographies. Our next move will be exploring type 2 polysomnographies at home sleep testing and specialist consumer devices, which are smaller wearable headbands that contain EEG signals. We've been in discussions with numerous providers of both over the last few months, and we can now push into these different markets. Of course, the holy grail opportunity ahead is to take our technology into the most used consumer wearables to provide further insights and objective measures on mental health assessment, ongoing tracking of sophisticated sleep analysis, reception to medication, and changes in external factors. So with that said, I'd like to leave you all with a quick snapshot of what's ahead for TrivarX. We're working quickly to finalise our pivotal study design prior to our next meeting with the FDA, where we'll get the final tick to begin enrolling patients before year end. As part of this trial, we'll commission new study sites across the US and hope to release news soon as some of the high volume and well-established centres we're in formal discussions with. We've also been speaking with several KOLs, both on the research scientific side, but also on the commercial sleep side, on potential board appointments to begin building out the strategic partnerships mentioned earlier. And by this time next year, we hope to have completed our pivotal trial and submitted our de novo application with the FDA. Thank you for all your time today. If you have any questions, please feel free to reach out at the booth afterwards, and I look forward to meeting some of you. Cheers.
Thanks very much, Kai. Interesting, isn't it? Really, really interesting. Next up on stage, we have Brian Leedman. Now, Brian Leedman is a serial tech entrepreneur who's carved out a reputation as a visionary in digital health solutions. His notable ventures include ResApp Health, the former ASX-listed company known for its diagnostic respiratory app, which was acquired by Pfizer in 2022 for how much, Brian?
Almost 200 million.
You're a happy man, weren't you?
I was.
Didn't retire though, did you?
For a little while.
A little while. He cannot resist a challenge. And he also has he's really passionate too about bringing things that make a difference to people, not just here in Australia, but also globally. So off he's gone on his next venture, and he's a co-founder of an organisation called BlinkLab. Now, BlinkLab has in their arsenal, they've designed an app. And if you've got anyone in your family who has a neurological condition, especially autism, and in our family we actually have two, and I first sat and heard Brian talk about this, I just thought, oh my God, this is an absolute game changer. It diagnoses autism early through blink reflexes, through a smartphone, through an app. The changes it could make could be absolutely life-changing. Would you please make him welcome? Let's see if it makes a change to your investment portfolio.
So thank you very much, Christy. So it's a really honour for me to be here on the stage again. I've actually been to every TechKnow Invest conference since the inception, about maybe 7 or 8 years ago now. And this is the new venture. It's called BlinkLab. It only listed on the Australian Stock Exchange in early April. It was actually the first healthcare company to list on the ASX this year, and it's done pretty well. I think the share price is listed at 20 cents. We're currently sitting around 26, 27 in what is a fairly bear market. But we have had a lot of good news flow since we started, but the main news flow, as I'm going to get into this presentation, is actually due in this second half of the year. And essentially what we're talking about is the world's first truly objective digital diagnostic test for neurological disorders such as autism and ADHD. And it all uses just a smartphone, so it's infinitely scalable. So following regulatory approval, this can be adopted by the medical fraternity all over the world for the early diagnosis of disorders like autism and ADHD. And so I've just got this slide here just to demonstrate that, you know, if you're looking at investing in healthcare, you want to invest in something that's really topical. And the most topical subject in healthcare in Australia and around the world is the cost of national disability schemes, and certainly Australia and the equivalent in the United States and the UK and so forth. They're all grappling with the same costs associated with the diagnosis and treatment for neurological disorders. So we're in a very, very hot space. But we're also in another hot space, which is artificial intelligence. Now that is also an incredible space. I mean, who wouldn't want to invest in companies like NVIDIA? This is where I would want to be investing my money, in a technology company that's exposed to the huge opportunity that is AI. And those two areas are combining together in BlinkLab, because you look at the market here for, say, diagnosis and treatment of autism, it's just an enormous market, just in the US alone. I know that the NDIS, we're spending somewhere in the order of $30-odd billion a year. And out of that expenditure, most of that money is actually being spent in children and in the diagnosis and treatment of autism. And how does it all work? So autism diagnosis is expensive, it's inaccurate, and it's often late. We're talking about a subjective measure. Doctors are looking at their children or these children. It starts off with parental concerns. Obviously, there's something not right with my child. Maybe he or she's not walking yet, or not crawling, or not talking, or whatever it might be. Now, in most cases, there's actually nothing wrong with your child. It doesn't change the fact that the parents are concerned about it. And so they want to start a process where they can at least rule in or rule out if there's a neurological disorder in my child. So this is a technology that could be applicable to all children, whether it rules them in or out of having a neurological disorder. And of course, the problem is that the actual current process is that these children are diagnosed late. Now, 5 or 6 years old, for all the parents in the room, you know your child already has a personality. And if the personality is showing displays of you think there's something wrong, it's very hard to change that personality at 5 or 6 years old. And what we're promising you here is the opportunity to diagnose these children at an age previously unseen. We can diagnose the kids starting off the same with parental observations, and then we introduce our digital diagnostic screening test, which is using a digital biomarker. And this is the first time we can use a digital biomarker, I'm going to explain how this works, that actually can diagnose a child with autism or ADHD and potentially other neurological disorders at the age of, say, 2 or 3 years old. That means that you can introduce treatment that becomes effective, not a waste of money, but an effective use of money, and particularly taxpayers' money in terms of NDIS. So you can actually introduce a treatment where you can change their behaviors through treatment. Remember, you can't treat anybody unless you diagnose them first. And then we always say in medicine, the earlier you can diagnose anybody with anything, the better the clinical outcome for the patient. So that's what this technology can do. Now, in terms of how it works, I'm going to sort of give a demonstration here, but it's basically a camera. It's using the forward-facing camera on the cameras to analyze the person's face. And by the way, this technology works just as well on children as it does in adults, and there's extensive clinical trials I'll talk about. But it's looking at the face, and the child is focused on the screen. Not hard to get a child to focus on an iPhone or an iPad, on whatever it might be looking at, but it's introducing a whole bunch of stimuli. So let's see how this works. So this is a neurotypical child. He's looking at the screen, and there's no sound. Why don't I have any sound? Can I try that again? Well, anyway, there was a beep then. There you go. So this child is focused on the screen. There's an introduction of a sound, and this sound is causing what's called the blink reflex. It's an automatic response. It's just like the knee reflex. You can't help it. And that is true of every human. Now, what we're having here is a double sound. Now, this is not new science. This has been long established over many decades. But what's going to happen is there's a little soft sound before the main sound. Watch what happens. No blink. Now, that is a perfectly neurotypical response. What happens when we introduce this to an autistic child? Again, a single sound. There's a blink. Now, if we introduce that soft sound before the major sound, blinks anyway. Now, that is a telltale sign for autism or ADHD. Okay, so now this is not new. We haven't invented this, albeit that we licensed this technology from Princeton University. It has undergone massive clinical trials, in excess of 8,000 patients that we have used to develop the algorithms in this smartphone in order to be able to do this solely on a smartphone. Now, there are other tests going on. I'm just simplifying this for you, but there are many, many neurological tests all occurring on the phone, both visual and audio, in order to come up with a diagnosis. And this is really impressive. So what we're looking at here is the blink reflex. And on a neurotypical person, you can see that the control there is there's no blink in that double beat. But you can see there in autism and ADHD, there is the blink, but they're different. And that pattern has been established over at 8,000 patients in clinical trials that we've done to date. And you can see that the pattern is different, and that pattern differentiates between autism and ADHD. Now, there's also the indication, and we have to still expand this through our clinical trials, but for the autism patients, we can actually place the child on the spectrum based on this test. And the diagnosis is instant on the smartphone. Now that would be a phenomenal outcome. Already this is incredibly commercial, but in order to place them on the spectrum as well from the test, that would be next level for me. So the technology is already developed. The application is already out there on the platform. This is what we're using for testing and the clinical trials. So we've developed the technology, all developed at Princeton University, and it's already been tested across in excess of 8,000 patients globally. These are huge clinical trials. So we've already well advanced before we even listed on the ASX. And the partners that we have are just remarkable. We're talking about a platform technology. And you can see from the organizations that have already signed up, and if you look at the announcements that the company has made since we listed on the 4th of April, they've all been these terrific partnerships. Most recently, there was an announcement with the Mental Care Group in Europe, one of the largest mental care providers. They're based in Amsterdam or in Holland, and that is a first clinical trial that we're doing towards getting regulatory approval in Europe for ADHD. That announcement was only made just this morning. But we've already made announcements with Turning Point in Chicago, a very prestigious mental health care group there. And I think last week we made an announcement with Columbia University. You're going to see some amazing announcements and partnerships for BlinkLab going forward, especially in this second half of the year. This technology was done prospectively in a clinical trial, and this is the most important slide for me. If you look at it, there's about 280 patients done a prospective double-blind clinical trial to test our algorithms against a known outcome for that patient. So we don't know that the patient is autistic or not, and we got a sensitivity and specificity score of 85% and 84% respectively, based solely on a smartphone. And remember, we're comparing to a gold standard, which is a subjective test, which is a psychiatrist reviewing the patient and coming to a diagnosis through questionnaires, scorecards, adding it all up, placing them on the spectrum. And this is based purely on a smartphone to compare that to, and the results are incredibly accurate. Now, there is a predicate here, which is really important. So my previous company, ResApp Health, was a de novo application. No one had ever tried or done what we did. Tony Keating sitting right here, my partner in that. And we'd never done that before in terms of taking a smartphone application, digital healthcare. And the FDA looks at it very, with a great deal of scrutiny. But what we have here is two other companies, TechKnow and ETD. Now, they are both private companies in the United States. They've raised in excess of $400 million, but they're doing it differently to us. TechKnow does use a smartphone, but it's not a smartphone technology. It's really just recording the patient. It's allowing the psychiatrist to see the patient remotely. There's not much smartness in it, and it's not very good either. 52% is really just a toss of a coin. ETD are definitely smarter, but they're not using a smartphone. They're using similar technology that we are, but using external cameras focused on the person's face. They come up with a diagnosis which is far more accurate, but not as accurate as us. And we're the only ones doing all those things combined into a smartphone, which means it's infinitely scalable. Now, this one slide, I'll just take a moment on. This is really interesting. So what we tried here was to actually see with ADHD patients who would take this horrible drug called Ritalin, and we're looking to see what the efficacy of the drug taking over the course of a day. And they're doing the test on our smartphone at every hour interval. And you can clearly see that after 2 or 3 hours, you can see the blinking has subsided there. So we're actually getting to a period of neurotypical behavior after 2 to 3 hours. Now, that is an incredible finding based on a subjective or an objective test on a smartphone where we can actually see the efficacy of the drug during the course of its treatment. And that's an area that I think Big Pharma is particularly interested in, and have already indicated to us that that is an area that they're very focused on in terms of showing the efficacy of their drugs. So that's a big finding for us. Now, it's a really good team. The company really came out of Holland. Professor Hank Jambol, he's a psychiatrist. He's also a professor at Princeton University where this technology was developed. Anton Uvarov is his partner in that. I've worked with Anton on a number of companies that we brought to the Australian Stock Exchange. He's the executive director, and there's also a great team based over there. And in terms of in Australia, we're not just a WA company, albeit we did found it in WA, but there's myself leading the company as chairman. Jane Morgan is a very good company promoter, and she's joined the board as well, together with Dr. Richard Hopkins. There's a great scientific advisory board as well. In terms of our R&D pipeline, it's all to me about autism and ADHD. Those are the two huge markets. Now, autism, I already mentioned, was a $700 billion market. You can multiply that by 5 when you're talking about ADHD, far more prevalent ill disorder. And we are getting into those clinical trials, the regulatory clinical trials in the United States in this second half of the year. That is where the real catalyst for share price growth, in my opinion, lie. In terms of our milestones, you can see that there are many milestones, but they're all due in the second half of the year in terms of real catalysts for growth. We have made terrific announcements to date. We have already signed up our CRO, which is the clinical research organisation in the United States that will be commencing that FDA registration trial. There'll be some significant news flow about that in the near term. That is going to be the real catalyst for us, I believe, once we start those clinical trials. We raised the money with $7 million. We're going to be spending it in those clinical trials. That's the whole purpose. That's where we'll get the share price growth. And it's a very exciting time for me to be presenting to you. I remember most proudly when Tony and I presented ResApp Health to you 7 years ago, and I believe the share price was up 2,500% within 18 months of listing. I'm not saying that we're going to necessarily do that. It'd be terrific if we did, but I think that we're on a nice trajectory. We're only got a market cap of $27 odd million today. We're poised for growth. We're outside. I really invite you to come and talk to us. Anton and myself are both here, and I very much welcome the opportunity to be able to present to you today. So thank you.
Thank you, Brian, an outstanding company to finish our first session on this morning. So that was your 6 first investment opportunities to consider. We've got 7 more before lunch at 1 o'clock. We've got a break now for about 25 minutes. There are 2 food stations, one in here. There's also one in the back room. So we've got two rooms out in the hall there. So go into the back room. If you can't make it through the first one, you'll hear the bell ring, and we will drag you back in here. I'm sure you'll be excited to do so. And if you'd like to have a look more at the analysis and the data analysis and what's happening around the conference, make sure you check out Market Tech. And when you're on there, register for that prize, and I'll be drawing that at the end of the day. But you do have to be in the room to win the